Welcome, everybody. Thanks for attending. I really appreciate it. I am going to I'm going to be moderating a little bit in the background and let some of the stragglers come in, but out of respect of everybody's time, we wanted to get started. So, Carl, do you want to say hi?
Hi, and thanks for joining, everyone. We want to welcome you to the Wayland Financial 2022 mid-year update. We've got a lot of interesting information to present, and I'll let Andrew kick it off.
Yeah, absolutely. So, it's really important for us to try and get out and provide a little bit of clarity. What we see, we live in this environment on a day-to-day basis. What's going on in the minds of our firm, what we think is going to happen in the economy. There's a lot of information out there with regards to, are we in a recession right now? When will we be in a recession? What does that have to do with equity markets? How will they react? So we're going to try and cover a lot of those things. Also, I did want to point out that, if you do have questions that you'd like us to answer, we're going to address those at the end. You can type in any questions that you may have in the chat section. I'll be able to filter through those and be able to see some of those questions that come in, and we'll try and get to as many as we can by the end of the presentation. So just a little bit of the agenda. We're going to kind of go over the market progress, where we're at right now. The equity markets have rallied over the last few weeks. We're on recession watch, and then we're going to close out by how we're going to position between now and the end of the year, and then we'll go into some Q&As. A little bit of disclosures to keep the attorneys happy. Just know that these views are ours as of this month, and they can change. And no future or no past performance is a guarantee of future market performance. And that these views are can change at any point in time, and that it's not a specific recommendation to buy or sell any specific security in your individual account. That's where we would want to talk one-on-one. So now that we've got the attorneys happy, Carl, let's kind of start out with a little bit of the market progress.
So this is where we've been over the last couple of years. This is a chart of the S&P 500, which is the most widely used U.S. equity benchmark, the 500 largest companies. And on this chart, we also have the 50 and 200-day simple moving averages. A lot of people like to look at those as a gauge of market momentum and and market trend. And you can see, going back to the spring of 2020, when the COVID crash happened, the market went down really quickly, broke through these moving averages, and then 50-day across the 200-day a little bit late. And we've been in a nice uptrend since then, due to the economy getting better, quantitative easing, accommodative monetary policy on the part of the Fed. And then this year, we started to get some volatility in January. Moving averages started to move lower, 50-day moved below the 200-day, and it still is there. We've had some nice bear market bounces over the last 6 months, and we're having another one right now. But the key thing to note is that we've seen this technical breakdown of the market below key moving averages. In the very bottom of this chart, we have a relative strength index, which shows how overbought or oversold the market is. Very short-term momentum. How is it doing? And
yeah, it's really key, if we look at these things, to point out that you really don't have a lot of upward true momentum until you get that blue line above that orange line. And since we're still below those, we're still kind of looking at this as potential bear market rallies that we've seen over the last few weeks. And that RSI, that line on the bottom, it gives you a range from 30 to 70 is that barrier there. And the closer you are to the top end of that range, you can kind of tell when the market tends to sell off as you get closer to that top end range, when the market tends to get a little bit more overbought. And we're currently seeing that right now.
Right. And often when you're at the bottoms over a longer period of time, or even over a shorter period of time, the relative strength index is hitting a low and is near that 30 level.
Right.
That's exactly. Let's go to the next slide. So this is a graphical depiction of where we've been this year in relation to past years for stock and bond market returns, and 2022 stands out as a historically challenging year for stocks and bonds, which is a rare thing. Most of the other years were negative for either stocks or bonds, but not both in a significant negative way.
Right.
And that's because we've had low interest rates for a long time, and now we started to see some real inflation, partly due to the easy policies and the aggressive fiscal policy, but also the war between Russia and Ukraine, that caused oil and other commodity prices to increase a lot this year.
Right. Yeah, the primary cause has been, inflation and what the Fed has had to do to combat the inflation. If I would have spoken to you in January of this year, the Fed was only forecasting getting the federal funds rate to only 1.5% by the end of December of 2023. And they did an about face as soon as they started to see this sticky inflation lasting much longer than expected. And now they're expected to have the federal funds rate, close to 3% by the end of this year alone. And that's a big policy change. And the higher the risk-free rate of return is, the lower valuations on equity prices alike. And the faster that they move those rate policies, the more interest rate sensitive investments such as bonds get hurt because they have a negative correlation to interest rates.
Right. So we've had inflation that we haven't had in a while, and the Fed has been starting to move aggressively to fight it. And the key thing is, what the future is going to look like there. And so that's what gets us to the recession watch that we're on now.
Right. Yeah, no, a lot of people have been talking about it. Clearly, we got the second quarter GDP that told us that we had two back-to-back negative quarters of GDP growth. That's on an inflation adjusted basis. GDP did still grow. Let's make that very clear on a real basis, right? But on a nominal basis, it did not. Or did I get that backwards?
And that may be fine,
right,
for now, because we have inflation, and it's hard for wages and other spending to really keep up with it. So it partly the reason the market's bounced the last few weeks is because it's become clearer that we're not quite in a recession yet, but not a lot has changed in the overall picture. And so we think we're pretty close to a recession. And so we have slides where we're going to get into a lot of historical information on this.
Yeah, let's
and what is underpinning our thinking and how we're positioned.
Yeah, and Carl, so like a big reason for this recent rally that we've seen in the market off the June or even July lows, depending on whatever index you want to look at, has been this thesis after the last Fed meeting that they were going to, maybe take their foot off the pedal on raising interest rates, and maybe they would even get to a point where they could start cutting rates. And the markets took it as, a higher probability of having what's known as a soft landing. Carl, can you explain what a soft landing is to everybody that's listening?
Sure. So in economics and business cycles, people talk about soft landings and hard landings. A hard landing is when the Fed hikes interest rates, the short-term Fed funds rate, to quell inflation, and you end up in a recession where unemployment goes up significantly and the economy slows. A soft landing is a situation where you have a little bit of inflation, they raise the Fed funds rate a little bit, but inflation is low enough that you're able to slow it down without causing a recession.
Right. Now, how many times over the last 70 years has a soft landing actually occurred?
It's pretty rare. And I think it's pretty funny that people are talking about this so much now and hoping for it. I think that's pretty overly optimistic, because it's only happened 3 times in the last almost 70 years. And every time that it happened, inflation was pretty low. In the mid 60s and the mid 90s, inflation was only 2%, when the Fed achieved a soft landing. And then in the early 80s, surprisingly, coming out of that double dip recession, where interest rates were still pretty high, around 10% or so, inflation was surprisingly only 3%, and then it picked up to 4% in 1984, and then fell back down to 3 and 2. So
we've never
point
had
is that
yeah.
really, in order to have a soft landing, you really need inflation to be low and controlled. It needs to go back to 3 to 4% or lower pretty quickly for us to be able to have that here. And so even though we had a good data point this last month with the CPI declining to 8.5, that's
Which, by the
nice.
way, was the same inflation as what we had in March.
Right. It could just be noise.
Right.
We don't really know yet, but it is nice to see that commodity prices are declining, gasoline is declining. Maybe we'll see other things decline, but there are a lot of things like rent, which are and wages, which are probably going to be kind of sticky. So
Yeah.
we don't really put much likelihood on a soft landing right now, given the whole environment that we're in.
Yeah, and to summarize that, there's been 3 soft landings in the last 70 plus years. And each of those soft landings have occurred when inflation was, 3 to 4% or lower, not at 8.5 or not at 5. And then that kind of transitions into this next slide, which is a little bit messy. But I did want to have this on here, and I'm glad, Carl, that you put it on here, because we haven't seen inflation in this country to the tune and magnitude that we have this year since the mid 1970s or the early 1980s. And what this chart looks at is, I'll break it down in that blue line that looks like a mountain, and follow my cursor if you can see it, peaks and troughs down over here. That blue line is the CPI index. So when you hear inflation, it's that consumer price index. That is that blue line. This purple line that staggers is the second most important part of this chart. You can see it stagger up in here, stagger up all the way there, come back down, stagger up. That purple line is the federal funds rate. So when the Fed says that they're going to be raising rates, they raise the federal funds rate. And what's important to point out in these previous 2 or 3 recessions from the mid 1970s and the early 80s is that in order to break the back of inflation, they had to get that federal funds rate above where inflation was. So if they're targeting roughly a 3% inflation or 3% federal funds rate by the end of this year, and inflation is still much higher than that, that tells us that the Fed still has to have their foot on the pedal to be able to continue to raise rates to soften inflation. Another point before I kick it over to Carl on this chart is every time in US history that inflation has been above 5%, the Fed has had to raise the federal funds rate above where CPI is. And yes, the economies are a little bit different now than they were in the 1980s, but we still think that it's more probable that the Fed is going to continue to have to raise rates to combat high inflation, specifically with how sticky it is and how low unemployment is at this point in time. Anything else you'd like to put on this chart, Carl?
Exactly. And the reason for that is that it doesn't really quell the demand for lending if you don't get the Fed funds rate above the CPI, because if there still is inflation out there and people can borrow for less than that, they're going to be incentivized to do that. Now, maybe someone won't be real interested in lending to them, but they still will be interested in spending and borrowing, even if it's on maybe even on a credit card or some other way. So
I just want to explain that because that's really important to understand for everybody that's listening today. If real rates, so real rates are what interest rates are net of inflation. If real rates aren't positive, meaning you can borrow at an interest rate that is less than inflation, that is a net positive for the borrower. And until they get short-term rates or lending rates above where inflation is, it's still a positive lending environment. Now, it may, like what Carl said, may be more difficult for banks to continue to make loans. It may not be as profitable for them, if profitable at all. But until they get those interest rates above where inflation is, you still do not have real positive returns or interest rates. Did I miss anything there,
Right.
Carl?
No, I think we're pretty good on that. And that brings us to the next chart. You know, we don't really know exactly what the path of the future Fed funds rate will be, or how much and how quickly inflation will decline. You know, it may be that you know, they have to raise the Fed funds rate and keep it higher for longer, or maybe they don't have to raise it all that high and inflation will come down and they just need to keep it high enough for long enough. But on this slide, we're trying to get an idea of what the expectations for that is. So there are Fed funds futures in the United States, but there are Eurodollar futures around the world. And what these are, they're derivatives where contracts where banks hedge their interest rate exposure in dollars to US interest rates around the world. And the values of the Eurodollar futures have implied interest rates in them like the price of a bond does. And so you can see that the price is going down, you know, the rest of this year, September and December, implying that there will be continued rate hikes this year. And then you can see in March of 2023, the value is higher than it is in December. So the world is expecting the Fed to start lowering the Fed funds rate by March of next year. Now, maybe that'll happen, maybe it won't, because there's been a huge surprise this year in the number of and the size of the rate hikes that they have had to do. But this is just one data point. It's possible that that'll happen. It's
And in order for them
possible
to,
that there could be a surprise to the upside.
and in order for them to actually be in a position to cut rates, we actually have to see inflation moderate a tremendous amount. And I'm not saying, you know, 5 or 6, it's got to be.
Right. We probably need, in order for them to do a rate cut in next March, inflation probably has to be below 4% by then.
Yeah, I agree.
And maybe it'll happen. We'll see.
So
On the next slide, we've got the, we're looking at the yield curve here, the 10-year, 3-month Treasury yield spread. And this is the reason this is so important to look at. There are a lot of different Treasury yield spreads that people look at, but this one is pretty important because it's one of the best near-term recession indicators that there is, because it's so tied to bank lending, and you know, because banks are lending long-term and borrowing very short-term from depositors. So whenever this Treasury yield spread goes negative, it means that there's no profit in bank lending, and so that tends to slow the economy down. And it's been a great indicator in front of all of the past recessions over the last 70 years.
Yeah, I want to explain that to everybody. So when you give your money to the bank doesn't just sit on that money, right? The bank lends that money out. It's a known business operations for banks. So when you give your money to the bank, if the Fed is raising interest rates, they tend to have to pay more interest on those deposits that you put in the bank. Now, maybe not if it's in a money market, but definitely if it's in a CD as an example. So the more money that they have to pay you versus how much they're getting to lend that money out, if there's not a large spread between those two values, banking institutions are less likely to lend out as much money in loans. So what this looks at is these gray bars are recessions. This blue line is the difference of the interest rate between a 3-month Treasury and a 10-year Treasury. So short-term versus long-term. And anytime it dips below this line is 0 here, you can see anytime it goes inverted, meaning that you're making more money by owning a 3-month Treasury versus owning a 10-month Treasury, there typically is a recession that follows not too far after. And that's something that we're watching. We're in a really decelerating pace right here. You've got the Fed aggressively raising those short-term rates. which is also another indicator for our recession watch tools.
Right. So that spread will probably be inverted after the September rate hike, but it depends on where the longer term Treasury yields are at that point too. So the next slide is the Conference Board Leading Economic Indicator Index. This is a well-known aggregation of leading economic indicators. It always tends to start rolling over ahead of recessions and declining as they're starting. And it has been declining over the last couple of months quite a bit. And so, it'll probably be, it'll probably keep moving in that direction. That was just another thing that we watch.
Yeah, along with this is the smooth line, right? So what the leading economic index looks at is multiple points from manufacturing to production, a number of different data points, and it smooths it out into a line. And what I like to point out to everybody that's on the call is here's the 2001 recession, here's the 08 recession. What you typically see, like Carl said, is it generally peaks and starts to roll over somewhere between 6 to 12 months prior to the next recession. You can see it rolling over here. You can see it rolling over here. And just recently, it started to roll over. That meaning that all of these different indicators that go into the leading economic index are starting to point towards at least some near or some future pain in the economy being tied to what's happening with interest rates as well as inflation.
Right. Now, normally that's not by itself a real big cause for concern, but we have elevated inflation and things are moving a little bit faster here than they typically do.
Right.
And so that's why we're paying closer attention to that and other indicators like it, which we'll get into more. But here's a chart of the S&P 500 performance around recessions. And this is why it's important to really pay attention to recessions. If they're really short, like the COVID crash in 2020, they can be over real quickly. But on average, sometimes you can see, sometimes stocks peak a few months before a recession starts. Sometimes it's before that. It just depends a little bit on the details of that particular business cycle. But, you tend to be in a bear market for about 12 months once a recession has started.
12 months. Well,
right. It varies a little bit by, severity and where interest rates are, but that's the takeaway from this.
right. And, if what we think is going to happen is true, well, January, February of this year would be about that 12-month mark.
Well, that's if the recession started, then, this will be,
Right.
Usually that gets to another thing that, we actually don't have. I don't think we actually have a slide in here about the unemployment rate going up during recessions, but that's another key thing. Generally, recessions don't start until the unemployment rate has gone up by about 0.5%. So that's, one of the interesting things is that even though we've had a couple of quarters of negative GDP, declines in industrial production and and significant, meaning at least 0.5% increases in the unemployment rate are part of the National Bureau of Economic Research's definition of recessions and how they actually date them. So you definitely can have periods where real GDP is negative and you're not in a recession. And often that happens when you're in a correction or there are other problems going on in the economy, but it doesn't necessarily mean you're in a broad-based slowdown.
Yeah. So what you said on the last slide was 8 to 12 months for the peak, right? Somewhere around there on average is the time period between when the S&P 500 peaks and the actual recession occurs. So that's the peak of the mountain. This slide looks at the trough of the mountain on when the S&P or the market typically bottoms. And this is an indicator that we use to kind of eyeball and estimate when a good time to start loading back in, right?
Right. So if you go back and look carefully over the last 50 plus years, what you'll see is that often stocks bottom when jobless claims are peaking, or the unemployment rate is increasing at the highest rate and then starting to slow down in how fast it's increasing. And it's interesting, the big recessionary stock market bottoms have usually happened within a few months of the month when jobless claims peak. The 2002 2000 to 2002 recession was an exception because valuations got excessive in 2000, and they had a long way to go to get back down to normal. But even then, you were much closer to the bottom than the top at the point when jobless claims were peaking.
Right. Yeah. So, I mean, it's a really good solid track indicator of when the S&P typically bottoms is a peak in jobless claims and unemployment rate increases.
Right. And it probably happens like this because when the unemployment rate is going up at a really high rate, a lot of people are losing their jobs. They're probably getting scared. Family members and neighbors are getting scared, and maybe people are just really starting to sell stocks and other risky assets.
Right.
So you just want to be aware of that and try to not be doing that, and maybe hopefully doing the opposite.
Completely agree.
So this is a couple of charts of S&P 500 earnings and what happens to them in recessions, and why it's important to just be aware of what drives declines. So there are a couple things that drive like stock market declines. There's valuation decline, and there's also earnings decline. And so in the last 3 recessions, earnings declined like 16% in 2001, in the financial crisis 39%, 20% in 2020. So significant earnings declines, and that's part of the driver of bear markets. But generally, the market goes down more than the amount earnings declines because valuation also comes down at the same time. Like, you wouldn't pay the same price for something if it suddenly wasn't growing as much as it was, or it was declining relative to what it was doing before.
Yeah, that's important. That's really important for everyone to listen to. So typically stocks move both up and down in 2 ways: valuation expansion or valuation contraction. The value of something is tied to the risk-free rate of return, or interest rates. So the move that we've seen mostly this year has come from valuation compression, and because of the rise of rates. The second leg of a bear market recession that we think will be in is going to be tied to earnings drawdown, so earnings compression, where, let's say, Apple, for example, says instead of earning $5 a share, we're going to earn $4 a share. And what Carl's pointed out in this chart is he's showing how much earnings had declined in those previous 3 recessions. And what's interesting to us as a firm is, despite the recessionary talks, despite the aggressive Fed policy, and despite the slowing of the economy, earnings estimates from Wall Street here on the right-hand side are still estimating earnings to continue to grow over the next 3 years. So we don't know how that's feasible in the eyes of all of these weights that are being put on top of the economy. And we think that it could be, the potential next leg of the market lower once we're in a recession.
Right. Expecting continued earnings growth like there's been over the last few years to go on over the next couple of years is probably wildly unrealistic.
To put it mildly, yeah.
And so far this year, here's a chart of like looking at this in a little bit more granular detail. And Andrew was already starting to talk about this, how the decline in stocks this year is due to the earnings yield rising in response to the Treasury yield rising. And you can see long term that the S&P 500 trades with an earnings yield, which is the reciprocal of the price to earnings ratio, and it's often higher. At least the last 20 years, it's been higher than what you can get in a 10-year Treasury. And that makes sense because stocks are a little bit risky. You know, the earnings can grow, but they can also go down. You know, bonds are safer. But these two lines, if you look closely at this, you'll see that these two lines have actually moved up in lockstep this year, which tells you that the decline in stocks that we've had this year has been entirely because the earnings yield of the market shifted up a little bit with the increase in the 10-year Treasury yield.
Right.
And the way you can see this is like at the end of last year, the 10-year Treasury yield was about 1.5. Now it's gotten close to 3. And a lot of stocks last year were trading, say, around 30 times earnings, you know, with, you know, like a 3% or so earnings yield, are now trading like in the 20s or so, the low 20s. So maybe an earnings yield of like 4.5% or more. And so that's about the same amount of increase that we've had in the 10-year Treasury yield.
Yeah,
And
essentially.
why that's key.
Yeah.
Reason that's key is that there's, you know, the decline that we've seen so far incorporates no element of risk aversion or decline in risk appetite, making people like scared of stocks and just putting, you know, making the S&P 500 earnings yield go up or earnings declines.
Yeah, so it's purely based off of interest rate moves, not so much risk appetite for risky assets, well, some risky assets, I guess, and no calculation for decrease in earnings. So it proves our thesis that this first leg of the bear market has been purely driven by the move in interest rates.
Exactly.
Yep.
So this is a slide talking about earnings revisions and how often you know, analysts are a little bit behind and they tend to expect earnings to continue to grow, and then after you know, after a recession starts, you know, they have to really cut their earnings estimates a lot, and they tend to be a little bit behind. And so that kind of you know, that's probably why the you know, in the chart on the slide prior to the last that we showed, the earnings estimates have still been pretty optimistic for the next
you can
couple of
see
years.
it. You can see it here. Earnings estimates have been continuing to climb, and you can even see it on this chart here. They're still expecting to climb despite all of these pressures. Now let's talk about this, because this is really interesting. You know, when we have our client meetings, we also include this chart, Carl, and this is from the St. Louis Fed, and it's their smooth recession probability. And why I wanted to just take over just in the beginning of this before I turn it over to you is that the last time we updated this slide, the probability was only 0.52. And now it's 1.72. So can you explain what this is? Clearly, by what I just said, it's starting to increase. Right now, it's telling us that there's about a 1.7% chance of a probability currently as of June. That's what that means, right?
Right. So this is a chart of the result of a statistical calculation based on the exact variables that the National Bureau of Economic Research uses to date recessions, and estimating what the recession probability is in real time. Now you need to collect the data, and you only know what it is for you know, starting a couple months ago. But essentially, it's got a very good record over the last 50 years. And whenever this recession probability starts to go up and gets like around 10% or more, you're almost certainly in a recession. And so it's a good thing to
but it's backwards
watch.
looking. But it's backwards looking.
Right. So you won't know, you won't have the data for a reading for a couple of months. So that's why the latest we know right now is for June. It's about a month delayed.
Right.
And the data do get revised as you go along. So
yeah. Now this
you
is,
don't really know for sure for a few months.
this is one of my favorite things that that we show clients. So everybody that's watching, this is probably one of the most important slides that you'll see in this presentation. And any kind of economic cycle, okay, it starts with an expansion, which is in that upper right-hand quadrant. Well, chicken or the egg, I guess, but we'll start with expansion. And then the economy slowly starts to decline. And then you get into a contraction, and then you slowly start to recover. So that is a normal business cycle: expansion, decline, contraction, which would be a recession, and then you slowly start to recover. And what this looks at is a multitude of different data points in the United States economy, from non-farm payrolls to unemployment claims, to existing building permits, to existing home sales, to consumer sentiment, to retail sales. And it plots it along this graph on where in the economic cycle each one of those data points are. That red dot is the mean of all of those other dots. So it's the average or the mean of all of those other dots. That green dot is the leading indicator of where that red dot should slowly be moving towards over, I believe, over the next 6 months or so. That's their estimate. And what's important to notice is the closer you get to the zero line, the more recessionary conditions that are actually present inside the United States economy. So this is as of last month, 7/29. I think it comes out every 2 weeks, right?
I think so.
Yeah, we should get a new one pretty soon. Anything else you wanted to add on to this before we kind of get into the comparisons of previous recessions?
No, that's a perfect summary.
Yeah. So you can see that we're slowly tracking a lot closer to this red line, meaning more indicators in the US economy, or more things that are going into this analysis, are getting closer to showing recessionary conditions. And this looks at all of those different indicators that we just showed in a dot plot. And it's giving us an indication that we're probably somewhere around 6 months away from an oncoming recession. And why we want to show you that is you can see the average right now is, where are we at right here, Carl? The mean of all those coordinates is about 13.1%, okay? And somewhere right around 6 months prior, down here, from the 90-91 recession, 01, 07, the weighted average is about 13.9, and that was 6 months prior. So that's what gives us an indication of saying, hey, are we truly having a soft landing? Is the Fed going to be in a position to actually do what they're supposed to do on their dual mandates, which is tame inflation to 2%? And if they do, does that mean that they have to keep interest rates higher for longer, which only puts more pressure on a lot more of those indicators? And this is the challenge that we've been, kind of fighting over the last, 65 days or so, as we look to position and reposition portfolios. And why that's important to understand this is, I'm not going to show this one, Carl, but it basically shows you the glide path. So this was in Q1 of 2020 during COVID, and you can kind of see, just like I said, it smooths out. When we were at the end of last year, you could see we were still over here in the expansion quad, which gave us confidence to continue to stay invested, that maybe corrections could happen, but nothing that was telling us drastically that things needed to change until the data changed drastically. But why I wanted to show you this is because this is 1 month prior to the 2007 recession. You can see it's fairly close, and I know, Carl, the scaling's off just slightly, but you can see 1 month prior to the 2007 recession, and if I go back to where we're at today, right?
Right. So we're a few months away.
Yeah, I mean, that one
close.
was 5.7%, right? And we're still at 13.1. But the point being is that it's not trending in the right direction to believe that, hey, the Fed's going to be able to properly maintain the economy in the state that they need to maintain it in, while also raising interest rates and combating inflation. Anything you'd like to add on that, Carl?
The leading indicator average is practically right on the zero line.
Exactly. That's exactly right. All right, Carl, let's talk about positioning. In our best estimate from the analysis that we've done is, somewhere between 6 to 12 months. And if we pick somewhere right in the middle, about 8 before the recession. And I've said to a lot of people, but to everybody listening, just because we use the word recession doesn't mean a financial crisis, right? It doesn't mean, that banking institutions are going to have to get bailed out. We don't see the systemic risk in the market like what we saw in 2007 to 2009. But that doesn't mean that recessions are fun. So we have, a theory of position of how we want to be positioned, and how we trade individual positions. So Carl, I wanted you to kind of explain, the two fundamental processes of when we're going through security selection. And that has to do with, first selecting the securities and trimming securities, as well as, the business cycle, which is kind of like the wrapper of the portfolio.
Sure. But before I get into this, I just wanted to mention too, that we've also been the reasons that we've been repositioning portfolios a little bit faster than maybe we otherwise would are that inflation has been surprising to the upside. Then the Fed has really been coming out with big rate hikes like we haven't seen in over 25 years. And also the world is a lot more sped up today, and people are reacting a lot faster with computers and everything than they were in the past. So that's why we've been trying to shift a little bit faster. But let's get into the investment process a little bit. So there are really two components of this. There's on the left-hand side, when we think about security selection, of individual stocks, or even when we're thinking about, where to be in bonds, we always, after we do a lot of fundamental work, we always try to arrive at a fair value that we're pretty confident in, and that for that security. And then based on our assessment of how risky it is, we decide how much upside we need to have in order to own it. And so that dictates our position sizing and how we get in and out of securities or other positions that we have in the portfolio. So you can see as the risk on something goes up, we need to have more upside or more of a margin of safety to start owning it.
Yeah, essentially meaning that, we calculate the fair value of an individual security. And what we do from there is we try to find opportunities that are trading below that fair value. That gives us that margin of safety. And like what Carl just said, the riskier the position is, the more margin of safety we need to be able to enter into a position in the first place. And
right. The reason that you like to have a process that works this way is because there's a lot of emotion in financial markets. There are crazy things and shocks that happen. And sometimes your estimate of fair value may not be what it really should be. And so it's kind of like building a house or a bridge or something. You want to build it stronger than you really need to, and over-engineer it a little bit. And so that's what the required upside or margin of safety is analogous to in more tangible real-world terms.
And then on the sell side, in normal market environments, we wait for those securities to approach or slightly exceed our fair value estimates. And at that time, we have the option to liquidate positions, or if something else that is more attractive on a risk-adjusted basis and potential return basis, that would be another indicator of selling in normal market environments outside of business cycles, right?
Right. And so we've been trimming things or selling things at prices that might be below our estimate of their fair value in the environment that we're in right now. But that's because maybe we feel like in the future, the earnings could decline, or maybe bond yields could shift up, and
Right.
maybe that would put more pressure on something. Or just from looking at the chart of how the market is trading, maybe it looks like we're at a point where, the upside is starting to get limited temporarily. So there are all kinds of considerations that can go into all of that. And then on the right, we are looking at business cycle timing, being aware of what's happening with the business cycle, and everything that we look for with the recession watch that we discussed
earlier today. Yep, I completely agree. So two components: security selection, and then the wrapper would be business cycle timing.
Right. So
reducing
it's important to be aware of what's going on with the business cycle, and how corporate earnings could decline, and getting into a bit of a more defensive posture before recessions, and then getting more aggressive coming out of the trough of a recession. We think that's a way to avoid losses and also add a lot of value. So in conservative, we've gotten a little more conservative recently. We, now that the yield on short-term treasuries, T-bills, has gone up, we've started to buy a lot of those, and we'll probably do more of that once the ones that we have matured. We sold some of the dividend-paying stocks that we have in there. We've continued to maintain our position in extended duration treasuries. Even though it's because we're in an inflationary environment, it's gotten a little uncertain how that will go. It's actually been holding up pretty well the last couple of months. The treasuries have rallied since the middle of June, and the movement in the S&P 500 has been highly correlated with treasuries. And given the whole environment, everything we've discussed and written about in the past, the high levels of debt, poor demographics in developing countries, we still think it's likely that treasuries will be a good hedge and a good place to be through the next recession. But we're waiting for a little more clarity on that before we add any more to positions there.
Great. And then how about growth, Carl?
And then growth, we've done some trimming on bounces the last few months. We've raised some cash, so we're a little over 40% cash now. We've started to buy some long-term treasuries. We have some gold, and we also have still a lot of our favorite positions, particularly in technology, that we love, but we've trimmed them back a little bit and diversified a little bit more so that we have less company specific risk and just broader exposure.
Yep, I completely agree. So before we get into questions, we've got a few questions, Carl, but let's kind of summarize our general thesis of where we're at and where we think we're going to be going over the next 6 months to a year. I know that's a really tough question, but just given how we're being positioned.
Right. There's no exact way to know exactly how things will go over the next few months, but we're pretty confident that we'll be in a recession within 6 months. We'll probably start having earnings declines next year, and the bear market will continue and take another leg down. We've had a really nice bounce the last couple of months, so we've done a little bit more selling, and we probably will continue to do more on bounces. It looks like this is probably a good time right now to be reducing exposure. And then, even though inflation has started to come down a little bit, I think we need to see a little bit more on that. We need to see that continue for a few more months. And where things are right now, it doesn't really change what the Fed is going to do. They're going to continue to raise the Fed funds rate, albeit at a slower rate. And we expect, to be on, even more of a recession watch with regard to that in another month or so.
Yeah, and everybody that's on here knows me. I'm an internal optimist, and Carl, I think when I brought you on board, I told you that I'm an internal optimist when it comes to the future of the country and the future of stock prices. And yes, we know that stocks go up far greater on average than they go down. But you have to also be realistic within that optimism. And, it's important for us to not only control, emotional investing, but also make sure that we have cash to be able to purchase assets at much lower prices. So it's not to be taken lightly that we, are making these decisions to allocate capital the way that we are, but it's because we have high convictions in what we think is going to happen over the next few months, or next 6 to 8 months. But I've got a question here. They say, how bad will the recession be, Carl? Now, if you can get this right, I'll give you a lollipop, but how bad will the recession be?
Well, there's no exact answer to that, but I can tell you a few things. One thing is that often the length of time that the yield curve is inverted, the 10-year Treasury minus the 3-month, often corresponds to the length of the recession and also the duration of it. So we haven't seen that yet. So depending on how, but we're close to it. So depending on how long that lasts, that'll be a clue to how long and how deep the recession could be. The other thing is that we have inflation that we haven't had before. All the mild recessions have happened when inflation was low and pretty moderate. So the fact that we have the kind of elevated inflation that we have, if I had to guess, I would say that this recession will probably be a little deeper than average. And the market decline, the stock market decline will probably be a little deeper than average. But there's no real way to know for sure on that. But the reason you say that is that if you look at where inflation is right now, it still is 8.5%. To really get it down to where the Fed would like it to go at 2%. Really takes a lot of slowing, and it probably really takes the unemployment rate going up a significant amount, probably more than in an average recession, because that's a significant difference between where inflation is now and where they would like it to go. And if you look at prior recessions where the inflation was that high, the unemployment rate tended to go up into the 8 to 10% range.
Yeah.
So I'm not saying that it'll go there, but
yeah, that's what happened. That's what happened in 1974, and that's what happened in 81 and 83.
Right. So taking all that information, if I had to guess, we'll probably have a little worse than average recession and a little worse than average stock market drawdown.
Great. Here's one, Carl, and you don't have to get political, but how will the midterms affect the stock market and the outlook?
Well, the good thing is you don't have to be political at all to answer this question, because after just about every election, midterm or presidential election, markets celebrate and rally afterwards to varying degrees, because there's change in Congress, which makes it difficult for the existing administration to do anything else, or there's change.
Right.
So we would expect some kind of a bounce or rally after the election, but often going into elections, because there's uncertainty about how they might go and what the outcome will be, markets tend to sell off into the October and really the couple weeks before an election. And the week before an election is a great time to be looking to buy things.
Right. Okay, last one I've got here. And if you guys have any questions, you can type them in. But the last one I've got here is, what areas of the market are most attractive now? I would say, if you asked me 2 weeks ago, I would have said technology. Right.
I would agree with that. I think a lot of the most undervalued companies that we see right now are technology companies, because growth has been hit hard this year. And there's also some, additional pessimism in those areas. So, when we look at the universe, and everything that looks the cheapest is, I'd say most of it is in technology.
Yeah.
Some of it's in consumer discretionary too.
Well, we're going to have this on replay again for everybody to be able to watch. You can share it with anybody that you know. We'd be happy to answer any questions one-on-one, or over the phone or in person. And Carl, would you like to close out by saying anything?
Well, we hope you all enjoyed listening to this and got a lot out of it. If you don't have any more questions now, and you think of some over the coming weeks, we'd be happy to discuss.
Absolutely. All right, everybody. Thank you for joining us today. Thanks for taking an hour with us. This is our 2022 summer outlook. Talk to you guys soon. Thanks.
Thank you. Bye.